While being slightly fast-paced, Opendoor Technologies is trading at exactly $7.14 per share, witnessing a brutal, gut-wrenching intraday collapse of nearly 16% on what was supposed to be its biggest day of the year. If you are watching the charts right now, you are seeing a sea of red candles that defies the manic expectations set just 24 hours ago. The volume is exploding, with over 58 million shares changing hands already, signaling that this is not just a minor correction, but a full-blown battlefield between aggressive institutional short sellers and a retail army that suddenly finds itself on the back foot. To understand the gravity of this move, you have to look past the ticker tape and into the psychology of the market at this precise moment. The expectation going into today, Tuesday, November 18, 2025, was nothing short of a fireworks display. This was Warrant Day, the day shareholders were supposed to be rewarded with a complex, localized financial weapon designed specifically to torch short sellers. The expectation was a squeeze, a vertical launch that would punish anyone betting against the housing giant. The reality, however, is a stark, cold liquidation event. The market is doing exactly what it does best, taking the most obvious consensus trade and ripping it to shreds. Instead of a squeeze, we are seeing a sell the news capitulation, combined with what looks like a coordinated effort to pin the price below key strike levels, rendering the very catalyst everyone was waiting for temporarily impotent. This massive divergence between what the internet promised and what the order book is delivering is the perfect storm for volatility. You have thousands of traders who bought in at the $8 and $9 levels late last week, anticipating that today's distribution of the Series K, Series A, and Series Z warrants would force an immediate repricing of the equity. When the opening bell rang and the stock didn't fly, panic set in. Weak hands folded immediately, triggering stop losses that cascaded the price down through the 780 support, and once that level broke, the floodgates opened. But here is where it gets interesting and where you need to pay the most attention. This drop is not being driven by a sudden shift in Opendoor's fundamental business model. Nothing changed in the housing market between yesterday and today. This is purely a structural and psychological dislocation. The sharp decline suggests that the smart money is potentially flushing out the late retail arrivals before the real game begins. Or, conversely, that the market has deemed the warrant structure too complex and essentially worthless if the stock cannot hold the $9 baseline. It is a classic high-stakes poker game where one side is bluffing with millions of shares, and right now, the bears are controlling the table. Let's talk about the elephant in the room that is driving this volume, the anti-short warrant dividend. CEO 𝐃𝐈𝐒𝐂𝐋 strategy to distribute tradable warrants to shareholders who held as of today was widely interpreted as a masterstroke to trigger a short squeeze. The logic was sound on paper. Give shareholders a reason to hold, and give short sellers a terrifying new variable to calculate. If the stock hits $9, $13, or $17, these warrants become valuable, essentially creating a massive liability for anyone shorting the stock. However, the market is a humbling mechanism. By driving the price down to $7.14 today, the market is effectively saying, your warrants are out of the money, and we are going to keep them there. This has created a curiosity loop that is keeping traders glued to their screens. Is this the end of the 2025 meme run for Opendoor, or is this a bear trap designed to lure in more shorts right before a violent reversal? The tension in the air is palpable because the float is heavily shorted. Approximately 25% of available shares are sold short, meaning that this coil is wound incredibly tight. If the price manages to reclaim the $7.50 or $8 level by the closing bell, the narrative could flip instantly. But for now, the reality is a painful lesson in market mechanics. Liquidity often exits exactly when euphoria hits its peak. To really grasp why this is happening, we have to strip away the hype and look at the actual setup. For the last 6 months, Opendoor has been the darling of the risk-on trade in 2025, rallying over 400% from its lows. It became the poster child for the housing market recovery thesis. Investors convinced themselves that the Federal Reserve's aggressive rate cuts throughout late 2024 and 2025 were the silver bullet that would instantly restore Opendoor's margins. The narrative was simple. Rates go down, housing velocity goes up, Opendoor prints money. But the market is rarely that simple. While rates have indeed come down, the lock-in effect hasn't fully dissipated, and inventory levels in the markets Opendoor dominates are still weirdly constrained. The company is essentially fighting a war on 2 fronts. They need volume to justify their valuation, and they need to prove that their new asset-light marketplace model can actually scale without burning through the cash pile they just finished rebuilding. Today's price action is a vote of skepticism. It is the market asking, okay, you have the hype, you have the memes, you have the warrants, but do you have the home sales? And so far, the answer has been mixed. We need to look at the specific mechanics of what is happening on the trading floor right now. The volume we are seeing, over 58 million shares, is well above the average, which indicates institutional participation. Retail investors alone do not move a stock like this with such precision. This smells like institutional de-risking. Large funds that rode the rally up from $2 to $9 are likely using today's liquidity event, where everyone is looking to buy, as the perfect opportunity to unload their bags. It's the oldest trick in the book. You feed the ducks when they are quacking. And right now, the retail forums on X and Reddit are quacking loudly about manipulation and crime, failing to realize that they are providing the exit liquidity for the very hedge funds they think they are fighting. This doesn't mean the stock is dead. It means the ownership base is rotating. We are shifting from early value investors who bought the distressed asset to momentum traders who are now getting washed out. This churn is painful, but often necessary for a stock to build a true floor. Now, let's zoom out a bit and look at the company itself, because amidst this chaos, the actual business of Opendoor is undergoing a radical transformation that gets lost in the stock price noise. Opendoor is no longer just the flipper of 2021 that bought high and sold low. Under Negetanian's leadership, they have aggressively pivoted toward becoming a two-sided marketplace. They are trying to become the Amazon of real estate, rather than just a digital pawn shop for housing. The distinction is critical. In the old model, Opendoor took all the risk on its balance sheet. If the market tanked, they held the bag. In the new model, they are connecting buyers and sellers directly, taking a cut of the transaction, and using AI to facilitate the pricing and inspection process. This is a much higher margin business if, and it is a massive if, they can pull it off. The Q3 earnings reported earlier this month showed signs of this. Revenue beat expectations at $915 million, but they still posted a loss. The market forgave the loss because the vision was compelling, but today's drop suggests that patience is wearing thin. Investors want to see the marketplace revenue line growing faster than the inventory revenue line, and until that crossover happens, the stock will remain vulnerable to these violent swings. This brings us to the sentiment analysis, which is perhaps the most fascinating part of the Opendoor story right now. If you spend 5 minutes on the dedicated stock twits or Reddit threads, you will see a community in the throes of emotional whiplash. Just yesterday, the mood was euphoric. There were price targets of $15 and $20 being thrown around casually. Today, that sentiment has curdled into anger and conspiracy theories. Traders are furious that the warrant dividend didn't immediately result in a squeeze. They are pointing to the availability of shares to borrow and accusing market makers of naked shorting. While it is easy to dismiss this as noise, there is a kernel of truth to the frustration. The short interest in Opendoor is objectively high, and the cost to borrow has been creeping up. There is a tug-of-war happening between a retail class that views Opendoor as a technology platform that will disrupt a trillion-dollar industry, and a skeptic class that views it as a low-margin capital trap that got lucky with a few interest rate cuts. This clash of ideologies is what fuels the volatility. You are not just trading a stock, you are trading a belief system. Furthermore, we have to acknowledge the macro environment of late 2025. The housing market has not rebounded as violently as the bulls hoped. Yes, rates are down, but home prices have remained stubbornly high, keeping affordability out of reach for the average millennial and Gen Z buyer, Opendoor's core demographic. The company relies on velocity, or the speed at which homes change hands. If people are just sitting in their homes because they can't afford to move up, Opendoor's